think about this from the perspective of if you're like a small business owner and you look at investing in that business, creating more customers, sales, and it becomes a virtuous cycle. It takes time. It takes time to build up a business. So the same concept is for any investment you make. The stock market is just the exact same thing. You're not trading pieces of paper, you're trading pieces of companies, you're trading ownership. So it's a long-term investment.
I have kids myself, but I feel like it could be almost like kids. You have it from an infant to an 18-year-old or a 25-year-old. And there's ups and downs and valleys and peaks. And it's like, hey, if you just look from infant to 25, you're like, Nathaniel was a great kid. You talk to his mom, you might have a whole different conversation, right? But because it's a process. And I think.
Welcome to Critical Thinking Required, hosted by LBW. This podcast is intended for free thinkers, entrepreneurs, and knowledge seekers. Join us as we discuss relevant financial topics, explore with guests their financial journeys, and engage with experts in industries such as space, media and entertainment, real estate, and many more. Buckle up and enjoy the ride.
Welcome to Critical Thinking Required. You're with your host, myself, Tim Bickmore, and my colleague, Nathaniel Leach, and he's feeling good today. So we're going to have a great conversation. There it is. There it is. I like the energy on the podcast. Let's go. So Nathaniel's all excited because we're going to be talking about finances, of course, and not just any kind of finances, but the United States debt. And actually, funny enough, internally, Nathaniel and I always have a lot of talks about the United States debt, what's going on, what's happening. It's always good and lively conversation. But the topic specifically around our debt it's always a hot topic, typically even in presidential campaigning or other things. It's a very hot topic within the United States of what are we doing with our debt. It is large, it is big. And the thing that has come up most recently is that we are hitting what is called the debt ceiling potentially, meaning Congress, I believe, Nathaniel, right, has stipulated that we can only go to a certain amount, a level of debt. In order to surpass that, they have to sign off on it and agree to it. So we are getting to that point, and that I believe is coming up in July, if I am not correct, Nathaniel. Is that right?
Actually, it's dependent upon the Treasury can pay the country's bills, and they're now saying that date is actually pushed up to possibly June 1st.
Oh, June 1st. Whoa, okay. So that actually has gotten pushed up. And so we want to discuss what the potential impacts of that would be if the United States government cannot come together and agree upon what that increase of the debt ceiling would be, as Nathaniel just mentioned, to pay for different things that we need to pay for. And that is what we want to discuss today, because we've gotten a lot of questions from clients and others, and we just want to kind of give our thoughts to allow people to know where we kind of stand on this specific conversation. Now, before we start and I start asking Nathaniel questions, we just want to say that this isn't the first time that this has happened. It has happened also in the past. And we do feel like, yes, there is a possibility, there is a probability that the U.S. could default on their debt. Now, that's what we're going to discuss. What would be the impact? But we also think that it's probably unlikely that that happens. We do think that the United States government will probably come together to put a bill together to be able to increase the debt ceiling. Now, that may come with austerity measures, meaning we're going to cut back on spending and do different things, right? It's going to be a conversation, a debate on how to make things better going forward. But there is a very real possibility that it does happen and Congress pushes it through, and that could cause some potential big issues within the United States. So that's what we really want to talk about today. I think we've mentioned to the viewers already. Again, we're talking about the debt ceiling, and that's what we want to discuss. So Nathaniel, if the United States were in, I'm going to put it this way. I always like how you say this. Let's put this in a vacuum, right? Let's put it in a vacuum, and then let's start releasing it from the vacuum. We're going to put this idea in the vacuum and say the United States hits a wall, and they do not come together to increase the debt ceiling, and they default. It looks like there is going to be some impacts, and let's start with number one, interest rates. What happens to interest rates if we default on our debt as the United States?
Interest rates will likely increase, is what's most likely to happen. So this will make it more expensive for people to buy things in the future. For example, on a personal level, if you wanted to buy a home, then what would likely happen is that mortgage rates would increase. It's unknown by how much. Some people say a couple percentage points. It could be more than that. It could be less than that, or maybe they might not do anything at all. But logic would dictate that interest rates would increase.
Okay. This leads me into the second point, right? Was what happens to the stock market? And I'm assuming that if interest rates do increase, that could also be a ripple effect into the stock market outside of just us defaulting on our debt in general. But could you explain how this may affect the stock market and what would maybe happen to the stock market if we were to default?
Sure. So generally, when interest rates increase, especially due to short-term events, then what that means is that a long-term duration asset, which includes stocks, corporate bonds. It can also mean mortgage-backed securities, because mortgage-backed securities are made up of mortgages, which are typically long-dated, 30 years assets. The values of those assets will come down. So, for example, in 2011, when we had a similar debt ceiling debacle, where at the last minute, the 11th hour, Congress and the White House came to a deal and we averted a default. The S&P did take away our AAA bond rating, and that did hurt the Treasury markets. But still, the treasuries are still the so-called riskless investment vehicle out there. It's supposedly risk-free. During that period, in July of 2011, the S&P 500 decreased approximately 18% over the next 2.33 months before it started to go back up again. So that's something like that could occur, but we're going to get later to how fundamental was that drop at that time relative to the long term.
Okay. So just to summarize, kind of going back to our first point, that if we default, we think there's going to be a sharp increase in interest rates. That could also affect different loans, different things for people to purchase. We also feel because of like long dated assets, as you mentioned, stock market, treasuries, mortgage-backed securities, you could see a decrease in price due to some of this defaulting and increase in interest rates, right? It's going to revamp the market a little bit.
Correct. And that would apply to be clear, that would apply to already issued debt or to the stock market in general. So for example, if a 30-year treasury that's issued today, the principal value of that, the price of it would, if the markets were to default a month from now, let's say, then the price of that 30-year treasury would decrease.
Because as interest rates go up, asset prices come down.
That's right, to compensate for the interest rates increase. Yes.
Okay. Now, our third point, inflation. Inflation's been a hot topic for the last 18 months, right? Or 12 to 18 months. It's gone up rapidly. The Fed is trying to curb inflation. What happens to inflation if we default on our debt as the United States?
It could lead to a sharp drop in the value of the US dollar, which in turn could cause inflation to increase even further. So for the past couple of months, inflation rate has dropped on an annualized basis from what it once was last year. But that's due to a whole smorgasbord of factors within the markets. But that could change if the US were to default. And it could then lead to another significant decrease in the standard of living for US.
Which then, theoretically, if the Fed tried to then continue to increase rates to curb inflation, that would also then lead to increase in interest rates, which then could lead to a market drop and so on and so forth. Okay.
It's a vicious cycle.
So it looks like we got 3 prongs to the cycle. We're gonna round it out with a 4th. So we've talked about the United States specifically, but as we all know, the United States and the dollar specifically is pretty influential across the world. So globally, what would happen if the United States defaulted? How would that impact the globe and other countries?
Sure. So I don't think that a lot of people understand how how important this is as a concept in the sense that the US dollar is the global reserve currency. That's actually a really huge deal. That is what enables the US to continue to print debt, to continue to fund its system and the ongoing obligations of the US government, such as Social Security, Medicare, the military spending, all of the other spending that goes into the basic things that we take for granted. I always like to use the fun fact of that the U.S. Department of Agriculture is technically responsible for making sure that birds don't fly onto airfields and get sucked into planes' engines and then potentially cause planes to crash, like the crash on the Hudson, for example. I mean, that was a fluke. That was a whole other thing. But just that concept, like who would have known that the U.S. Department of Agriculture was responsible for that? Taxpayer dollars go towards that, what turns out to be a fundamental need to make sure that flight crashes don't happen. Who would have known? So all of these are funded by the US government, which in turn is enabled by the US dollar being the global reserve currency. What does being the global reserve currency mean? It means that typically across most oil markets, the US dollar is used to settle those kinds of trades. But over the last, I mean, ever since the dollar became the reserve currency, there have been other nations that have been battling to get their currency or perhaps a basket of currencies to act as the settling currency for these kinds of fundamental commodity settling trades. And it's a very big deal because if the US is no longer the reserve currency, then it becomes much more difficult for the US to really have a say in the world's stage in many different ways. So if the US were to default, this could become a potential catalyst to erode the US's status as the reserve currency. It's a big, big deal.
Okay. All right. All right. That's a big one. So the four factors that we're really looking at is increase in interest rates, a potential stock market drop. You could have increase in inflation, which then could increase interest rates, which could be worse on obviously long-term dated assets, like you mentioned. And then it also could be an impact from a global perspective on other countries if we're default. So there's a lot of real factors that could be pretty detrimental if the US does default on the debt. Okay. So we got kind of a good handle. Thank you, Nathaniel, for putting this all together. Now we want to talk to you a little bit about how do you prepare for this? When you're looking to invest and you're looking to put money to work, how do you prepare for something at this magnitude, right? That could be a thing. Just want to know what your general thoughts and perspectives are on that specifically.
I think that there's a number of different ways that the academics, from that academic perspective, are preached in these kinds of scenarios. So first of all, it's important to note that this may not happen. The US may not default. And then even if it does default, everything that we've just talked about, they could happen, but the degrees to which they happen is completely unknown, because we always like to talk about how economists think that it's so easy to determine this variable and this variable and how this variable is going to affect X, Y, and Z. But it's not that simple, because the markets are made up of literally billions of people making decisions on a daily basis, on a microsecond basis. And all of those decisions are factoring into what actually happens in the world as we know it today. So it's very hard to try and forecast that. So we don't know what's actually going to happen. But what generally speaking academics would say is that you should diversify your investments, although we have some thoughts on that. Avoid high levels of debt if you can on a personal level, and perhaps on a business level if you're a small business owner. And we would say like on the personal level, like a mortgage is okay. Like if you bought an appropriately priced home, the interest rate is reasonable relative, and then your payment is reasonable relative to your income, and you can support that payment. That's a different kind of conversation. But if you have high levels of credit card debt or stuff of that nature, that's not generally a good thing to have. And then we always typically recommend that you have an emergency fund on hand. So, and however that emergency fund is invested, make sure it's liquid, easy to access when you need it.
Okay, I like those core tenets. I mean, that's very good from like even a financial planning perspective. But I do agree in the diversified investments. And just to mention too, Nathaniel said like, hey, we have some different thoughts. I believe Nathaniel, it was just last week that we discussed this with Charlie Munger and Warren Buffett and the Berkshire meeting talked about diversification. So if you are curious on Nathaniel's thoughts, go ahead to that podcast. That'd be great. Okay, so essentially we want to diversify investments, which makes sense. We want to avoid high levels of debt, and we want to have an emergency fund. It's pretty straightforward. It's pretty simple. As I always mentioned, it's usually a little bit more complex on the back end. You have to make sure that you're in the position to do that. Where is your cash flow really going? How much are you really spending? And just being more aware of your finances. I think Dan says that very well. The awareness is key to be able to make sure that we can execute on those three simple steps. But let's talk a little bit more about like in real life, Nathaniel, IRL, as they say. How do you really go about making this happen? What kind of steps from an investment perspective would you recommend or even just state when it comes to all of this quote unquote noise? I think in our world or investors, people talk a lot about noise. So how do you get through the noise and make sure that you can continue to be consistent within your path?
I think that's an excellent question. And I think that that's a really good point on blocking out the noise. It takes discipline to block out the noise. So, what we would say for what we not only practice ourselves, but what we also preach to our clients is that the golden rule is to position yourself with complete and consistent financial planning and actually then execute the plan. And it's not just a one-time plan. It's ongoing iterations. It's ongoing positioning. It's not just a one shot kill situation. It's a ongoing practicing disciplined execution. Don't deviate from your ongoing investment contributions, or perhaps if you're in retirement, distributions, be it your 401k or other retirement accounts. Consistency is key. History has consistently shown that if you ride out the troughs and the peaks of the market and you consistently make those contributions or distributions on a consistent, frequent basis, you will do well over time.
So that's a really good point, Nathaniel. I like that you kind of bring up this consistency. And I want to circle all the way back to something that you made in the points when you talked about the stock market downturn. You had mentioned that the stock market in 2011 dropped by 18% when the United States got close to defaulting on their debt. As you mentioned, the S&P actually did downgrade some of that debt for the first time, I believe, in the United States history. That brought down the market. Could you tell us a little bit about exactly how that happened in the short run, and then what was also the long-term impact of that specifically within the stock market?
So the aforementioned 18% decrease that I mentioned, approximately 18% decrease, actually happened from July of 22nd of 2011 to October 3rd, 2011, for which it decreased about 18%. If you would remain invested from July 1st of 2011 to March 31st of 2023, you would have achieved an annualized return with dividends reinvested of 11.8%. That's annualized, folks. So that 18% drop is, relatively speaking, a small blip given a long enough time frame. That is key when it comes to investing. What I always like to harp on is that think about this from the perspective of if you're like a small business owner and you look at investing in that business, creating more customers, sales, and it becomes a virtuous cycle. It takes time. It takes time to build up a business. So the same concept is for any investment you make. The stock market is just the exact same thing. You're not trading pieces of paper. You're trading pieces of companies. You're trading ownership. So it's a long-term investment. The public traded stock market is simply a means to take these corporations and allow for people to have ownership interest in them, and it's just more liquid than perhaps a small business owner or owning a private company.
Thani, I really like your analogy too of like time, right? And for all of our listeners or viewers who are sports fans or who have played sports, I'm going to use this as an example. It's like a season. Now, a season is not even as long as a market, but you have practice, you have pre-practice, you have post-practice, you have games. You may have a great game, you may have a terrible game. You're going to go through this whole season of ups and downs and lows and highs and valleys. But if you said, hey, I want to start where I started the day one, and then let's say you won the championship of whatever sport you're in today, 365 plus, right? You'd be like, that was success. But in between that, it was miserable. It was terrible. You had ups, you had highs, you had lows. You didn't know if you were going to make it. You just didn't know, but you just trusted the process, right? It is part of the process is that you're going to have your ups and you're going to have your downs. But what's hard is that living through those ups and downs on a day-to-day basis is extremely difficult. But if someone were to take a step back and just see you from A to Z, they're like, what are you talking about? That was no big deal. It was super easy, right? Like it all worked out. And you're like, yeah, but you don't understand the nuance behind what really was happening. And I feel like that is a good way to kind of explain what it would be. Even if I don't have kids myself, but I feel like it could be almost like kids. You have it from an infant to an 18-year-old or a 25-year-old. And there's ups and downs and valleys and peaks. And it's like, hey, if you just look from infant to 25, you're like, Nathaniel was a great kid. You talk to his mom, you might have a whole different conversation, right? But because it's a process. And I think that is what we're trying to explain is that stock market is also a process. And there is going to be peaks and valleys and ups and downs, but you have to trust that discipline and consistency over time to achieve that result that then everybody takes a step back and says, well, Nathaniel, that was pretty easy, wasn't it? And then Nathaniel's going to tell you, well, let's sit down over maybe, a dinner and I'll explain really what that was like, in a sense. So I just wanted to kind of give that as like an antidote outside of like an actual stock market that there's a lot of similarities to those types of things.
I think my mother would agree with you on that, Tim.
Yeah, I think my mom would too. So that's why I was comfortable saying it. All right, Thani. So I just want you to just provide our viewers just some lasting thoughts of that you may have on all of this of potential defaulting. I think you've done a great job of explaining what's going on and how we can potentially combat it or help, move forward with a lot of this. Because as both of us recognize, it's a real threat. It just depends on the probability of the threat and what will happen going forward, which is very unknown. But I'd love to just hear your final thoughts.
Sure. So it's always a possibility that the US could default. We're a relatively young country, and unfortunately, Congress has shown signs of unwillingness to compromise. But that said, there have been events much greater than a default that have occurred since our country's founding. And just within the last 100 years, I could take the examples of World War II, the oil embargo in the 1970s, the saving and loans crisis in the 1980s and 1990s, the great financial crisis in 08, 09. In the end, we have always bounced back due to the strength of our political, and we know that this sounds hollow today, but historically, our system is quite strong relative to other countries and our legal and regulatory systems. The US has a business-friendly framework that comprises of these three core areas, which allows people and businesses to bounce back relatively quickly, again, relative to other countries. In the short term, sometimes these things, they just don't look too good in the moment. But in the long term, it all tends to even out, in our opinion.
Nathaniel, I don't think I have anything to add. That was a really good ending summation of what's been going on. I don't know. I'm good. I don't have anything to add. I'm gonna pause. Well,
I'll take it.
thank you, Nathaniel, for giving your thoughts on this. This is, again, a big topic that's out there. If anyone does have questions, we're always here to help answer them, specifically how it affects you personally, and how, right, we're always looking for customization in regards to that. And as Nathaniel mentioned earlier on, we are big believers that financial planning is an iterative process over time. So just like I just mentioned, so we're always happy to revisit, relook at how things are as information changes, because the one thing that is consistent is inconsistency. So we really appreciate everybody's willingness to listen to us talk a little bit about U.S. debt, and we will talk to you next time. Thank you.
Like and subscribe.
Thank you for taking the time to start your journey of thinking differently and listening to LBW talk about stuff they love. Until next time.